Yeah, so I'm going to introduce. Hey, I'm Harrison. You're kidding me? Oh my gosh. Are you practicing right now? Oh, I haven't. Oh, you thought all that was. Oh, I wasn't even.
Oh, rolling.
And hey guys, I'm Harrison Lilly with the Harrison Lilly team at Keller Williams over here in Monroe, Louisiana. Today I have with me, this is Justin Underwood. He is the market leader and loan officer for Movement Mortgage here. And something that you guys should know about Justin, he is currently the #1 by volume lender in Northeast Louisiana right now. So the guy not only comes from contribution, but he also has a lot of success and knowledge in the mortgage lending area. So anything you'd like to say, Justin?
Yeah, thanks for that introduction. Yeah, our team is #1 in purchase transactions, and we couldn't do it without great real estate agents like Harrison, who during this it's a little bit of a difficult season, who's still been able to move and sell houses.
Well, thank you. I appreciate that. So, Justin, today we're here to talk about the recent mortgage rate increases. I think 48 hours ago we got hit with one. Yeah. We are expecting more in the future. I know we're definitely expecting multiple next year. So the first thing I'd like to talk about is mortgage rate increases and how a possible buyer right now should come prepared to the market with those changes.
Yeah, and Harrison, to kind of build up to what's going on right now, rates have been steadily increasing since we elected our new administration in 2016, and the economy is roaring, really. I mean, I think I saw today that unemployment is at its lowest point since 1969.
Wow.
And rates are not going up because the economy isn't doing well. The rates are going up because the economy is doing well.
It's almost too well, right?
Yeah, well, it's if you look at your 401k last year, you're really happy, but if you were in the market for a home, you saw rates going up, and that's what happens. Investors leave safer investments such as bonds, and they go to more riskier investments such as the stock market, which is doing really well, and that means prices of interest rates go up because the bond market really influences interest rates. And what we've seen is the Feds, who are the largest buyer of bonds, have stopped. They're no longer doing quantitative easing. And what that means is that the market is reacting more naturally, and it looks like volatility, so it can change all at once. And what we saw on Wednesday was probably the largest drop, which is negative, increase in interest rates in probably 2 or 3 years.
Okay, and so what did that do to the interest rates? How far did they go up, Justin?
Yeah, and so remember that the price of rates are constantly in fluctuation, but basically you saw about a quarter difference in rate. So if you were looking at a 4.75 rate a week ago, now you're pretty close to 5.
Right, and so just to define what rate means to a buyer, and this is my understanding, so please correct me if I'm wrong. So a 1% rate increase would be about a 15 to 20% affordability drop to a buyer. Is that correct? Yeah, so when you're looking at someone's ability to afford a home, the lender's wanting to know what is their debt to income ratio, okay? And the house payment, which is what they pay per month, factors into that debt to income ratio. Well, that monthly payment, the size of it, is impacted by the interest rate. So the lower the interest rate, the lower the monthly payment, the higher the interest rate, the higher the monthly payment, and that then affects the amount of money they can borrow. And the amount of money they can borrow affects the sales price, right? Right.
And so when we talk about affordability, if rates are going up, then their monthly payment is going up even for the same amount of money, which affects their affordability, which means they may have to buy a cheaper house to be able to afford it with the same payment.
Right, so somebody that could afford and were previously qualified for a $200,000 house may have to start looking in the 190s or 180s.
If a $200,000 house calculated to a $1,200 a month payment, well, now maybe a $190,000 house calculates to a $1,200 a month payment.
Right, wow, that's a huge difference.
It is.
And so, since we've addressed that now, so I'm a current buyer in the market right now, and I'm looking to go get ready. I've been to my mortgage lender, but the rate increase just happened.
Yeah.
How do I start to get prepared for that, Justin?
Well, what I would do with that customer is I would help them understand that your monthly payment calculation isn't just the interest rate. You have homeowners insurance, property taxes, and then you have mortgage insurance, which is our PMI for FHA, which is anytime you don't put 20% down, it factors into your monthly payment. And what I would do with that customer is really figure out how can we address their loan to maybe reduce those other aspects, whether it be reduce the homeowner's insurance, reduce or remove the mortgage insurance, so that their overall monthly payment is lower, even though the interest rate may be higher.
Gotcha. And so there's ways to calculate and move things around to help people fit into their goals?
Absolutely. Another option is if you ever have a lender quote you an interest rate, that's not the only rate available. You can typically get a lower rate, it just may have a higher cost at closing, and you can get a higher rate for a lower cost at closing.
Okay, very cool. All right. And so if I'm a buyer, should I be scared right now?
I wouldn't say you should be scared. The truth is, historically, this is still a really low rate. I mean, I got my first house in 2002, and my interest rate was 6.25%. I was happy to have it. My second home, my interest rate was 5.875. I was very happy to have it. And so we're not even there yet. Like, that was in 2009 when I got my second home. So the houses were still selling. People were still being able to afford homes even with less income than they have now. So I don't think that you should be scared by any stretch of the imagination, but you do want to make sure that you're thinking through the behavior of your home ownership. Meaning, am I going to own the home for 30 years? Am I going to own the home for 3 years or 7 years? And then sitting down with a lender who's taken the time to understand your behavior with your home so they can structure your loan where the volume of interest you pay is lower and it doesn't impact your approval and your finances.
Okay, so I think the main takeaway here is that go talk to your lender. If you don't have one, Justin Underwood over at Movement Mortgage is a great choice. As you can tell, he's pretty knowledgeable about this. So Justin, have we talked about everything that we discussed we want to talk about with buyers?
I think the other thing is how it impacts sellers. And so what I would tell sellers is you need to be really thoughtful about how the rates are affecting your buyers. So when you're getting an offer, really think through that. You need to also think about how you might could come alongside your buyer to help them get their rates lower. And that can happen through seller concessions or seller paid funds to help lower the interest rate for the buyer.
Right. Okay. And so if, let's say that you were a seller today and you had a $300,000 house, what would be your pricing strategy?
Yeah, so for me, if I was talking to my real estate agent, I would say, hey, look, if the value's there and the price is still there, rather than lower my home 10 grand, I'd rather offer $3,000 more in concession to lower the buyer's interest rate. And I net $7,000 more, but the buyer can now afford the home because they were able to pay to lower the interest rate.
Okay. And so let's say because of the rate scare, because obviously this is going to put some buyers on the rocks. Mm-hmm. It is. And I know personally, I have 2 or 3 that are just like, well, you know, there goes my interest rate. I don't even know if I want to buy anymore.
Yeah.
You know?
Well, one of the things I've always found interesting is a lot of sellers think that the buyer has to make the offer. That's actually not true, especially in the Louisiana buy-sell agreement. The seller can actually present an offer to a buyer. And it changes kind of the aggressiveness of selling a home, and it does change some of the leverage, so you really want to talk to your realtor about it. But as a seller, if you've had somebody look at your home recently and you feel like they did like it, but it wasn't quite affordable, why don't you sit down with your real estate agent and come up with a strategic way of making an offer to the buyer where you can show them the affordability. Someone like me as a lender could show them the appreciation that they're going to get in the home and see how much money they're actually going to make over time by buying that home to get an accepted offer.
Okay, yeah, that's definitely interesting. And so I just want to take this one more place. So again, you are the seller with the $300,000 home, and because of the rates, obviously, again, buyers are back on the rocks, and we're not getting showings.
Yeah.
And my realtor or your realtor rather, has talked to you about getting a price drop, and nobody wants to do that in their home.
Yeah.
Do you think it's appropriate to price with the market or ahead of the market because we know where the market is going?
Yeah, it always starts with your desire to sell and timing. But I would tell you price fixes everything, right? And so if you're having showings and you're not getting an offer, or you're not having showings, you got to address the sales price. Assuming that the house is being properly exposed and the market's aware of the home, which today is easier than ever to really expose a house.
Right.
I would say that price is probably the issue.
Okay, all right. Are there any other things that we should discuss in rates today?
No, I think that's it.
I think they got the advanced lesson. Like, you guys are college graduates in mortgage rate increases of 2018.
Thanks, guys.
Thank you.
Bye.